Hey guys, in this video we're going to discuss selling property on an installment sale. Okay, let's get started. So here's the deal. You've got a piece of property and you want to sell it to a tenant or a buyer on an installment sale. And what that means is that you're going to act as the bank. So you're selling it to the individual, they're going to give you some money down, and then you're going to carry back a note and they're going to pay you over time. And maybe there's a balloon payment in there somewhere where it's expected that they're going to pay it off, say within 3 or 5 years. But the fact of the matter is that you're not getting all your money out of the deal right away. The tenant is going to be paying you over time. Now, most people assume as follows, that when they sell the property, let's say that I bought the property for $100K. All right, so that constitutes my basis in the asset. That's what I paid for it and put into it. And I sell it for $200,000. Now, I know these are big numbers here, $100,000 difference. And before you start leaving comments on my channel, Clint, you wouldn't sell it for an extra $100,000 gain unless you held it for a period of time. That's not what I'm getting at here. What I'm getting at is I just want to show you how the numbers work out. So in this example, I have $100,000 in gain. So when I sell it to the individual on an installment sale, I'm selling it to them for $200,000 and I'm going to carry back the note. So maybe I tell them, hey, I want 10% down. So they're going to give me $20,000 up front. And it's going to be at, maybe I put the note at 5% interest. Okay. And so each and every month, they're going to be paying me principal and interest. So assume they paid me $1,500 a month. Let's say that was the mortgage amount that we have on this property that they agreed to pay us based upon the amortization schedule. So they're paying me $1,500 a month. Now that $1,500 a month payment that I'm receiving, that's going to break down into different components. So when you sell property on an installment sale, the payments you receive on a monthly basis will be broken down into a couple different components here. One is going to be return of basis. Okay, so that's return of basis. That's what you put into the property. All right. Now, return of basis, no tax on that. Okay, because you're just getting back out the money you put into it. Another portion of this payment that you're going to look at is depreciation recapture. Because you were depreciating that property, and depending how long you've owned the property, there may be a lot of depreciation or a very little bit of depreciation in that property. Now that portion of the payment is going to be taxed at 25%, straight line recapture on depreciation. Then you're going to have a portion of this that comes back to you, which is going to be your capital gains. All right, so if you've held this property for less than a year and when you sold it, so assuming that you got into the property and you're holding on to it for 6 months and then your tenant came to you and they made you this crazy offer, $100,000 if you agree to carry the paper. And you're like, sold. Okay, so then in that case, because it was held for less than a year, it's ordinary income. Now, if you've held it for more than a year and this transpires, then it's going to be taxed at long-term capital gains rate, not the short-term rate. And in that case, it'll be 20% typically. So let me just assume this is held for more than 1 year. So that portion of the income will be taxed at 20%. And then you're going to have interest. You remember 5% interest? So then you're going to have a portion of interest on that, and that's going to be taxed at your ordinary income tax bracket. So let's say your effective rate for your tax bracket is 25% there. So that's how all this is going to break out. So on that $1,500 payment, let's assume that, actually, let's just bring it all the way up forwards. For the entire year, you'll bring in $18,000. And of that $18,000, maybe $7,000 is the first one, the return of basis. So zero tax on that. Depreciation recapture, maybe that was only $1,000. So that's $250 in tax on that. And then you got the capital gains. So the capital gains portion of this is maybe $4,000. So 20% of 4K is $800 there in taxes you'd have to pay on this 18K. And then you got the interest, which is the remaining 7, 8, 12. So that's $6,000 again, these numbers are not accurate at all. So whatever 25% of 6K is, what's that, 2,500? So let's say it's 12 or 1,500, whatever that number is. So the point is that maybe you pay $2,250 in tax spread out over all these numbers when you've sold this property on an installment sale. And the same thing would happen with the money you took up front. You would break it out. Now, here's the thing that you have to be aware of when you're selling property on an installment sale. That's so important and gets people tripped up all the time, and they end up not having enough money to pay their taxes. So when you're selling this property, the one example I just gave you right here, this was an investment property. What does that mean? It means that when I bought my house here, I put a tenant into the property and I intended to treat this property as an investment, right? I was going to hold it long term. I was not flipping. Now, if you're flipping property, you've got other problems here, right? If you hold it as an investment property, then you get to use this type of taxation where you're going to bust it out. But if you're flipping, we have to look at it from a different angle. So here's what I'm going to do now. This is going to be a little longer video. I'm going to discuss the installment sale with entities and how that works from an investment standpoint. And then for you flippers, you better stick around, because the next aspect of this we're going to walk into is how you can get hammered on taxes with installment sales if you don't know what you're doing. Okay, so let's talk about the investment side of this. So what comes up a lot is, hey, what do I do with my investing when setting up an installment sale? Because if you watch my other videos on the channel, I tell you this, hey, set up an LLC, put your property in a limited liability company like so. And so you're treating it as a rental, and many times you're going to have a Wyoming LLC down here, right here, that owns this state-specific LLC for anonymity and asset protection purposes. So when you enter into an installment sale, it's not like a land contract where you still hold title to the property. In an installment sale, you're actually selling them the property and you're taking back the note, okay? Now, if I'm selling this property to this homeowner over here, this tenant that decides they want to buy the property from me, I'm going to sell them the land, take back a promissory note, and my LLC is going to take back a first deed of trust. That's what that DOT stands for, first deed of trust or a mortgage, because you got to have security, right? So you're going to take whatever's owed. In my example, since they gave me 20 down, they owe me $180,000. I'm going to take back $180,000 first deed of trust on that property. That's what the buyer is going to give me. So I'm in first position. This is key. If you're ever selling property on installment sale, don't do this. You need to be a secured creditor. If you're not a secured creditor, they could go out, leverage that property with somebody else who could step in front of you. So always work through a title company to get this in place on the property when it's sold. Now, I've sold my property, and so what does this LLC have at this point in time? It's going to hold the deed of trust against the property, and it has that promissory note. So, is that an asset? Well, yeah, it's an asset because note buying, that's a technique to invest in real estate. You can buy other people's notes. So this note has value. And so here's where I see a lot of real estate investors screw up their strategy planning. They look at their LLC that they've sold the property out of, and rather than do something, keep it as is, or maybe move the note, shut it down, they think, oh, this LLC doesn't hold any other assets. Wrong, it holds a note. So I'm going to go out and buy another piece of property and put it in this limited liability company. And I'm going to do that. Okay? So here's what you just did now. You've taken a dangerous asset, real estate, and you put it with a safe asset, a promissory note. That is a problem. You should never mix these two. So what I would encourage you to do in this situation, if you're selling property on an installment sale with an LLC that holds the promissory note, and you want to reuse it, which I don't know why, set up LLCs are set up, to be put into place and then shut down when you sell a piece of property. I've got plenty of videos on that of why you should do it. what I might recommend you do is if you're going to do a lot of these, set up a different entity to hold your notes. And so you can assign the note over to a third entity or put it down here in your LLC and get it out of there. So now the tenant will have to pay this entity. I mean, this happens all the time. So let's say I set up a separate LLC over here. This is my Wyoming Note Holding LLC, note holding. And what I'm going to do is I'm going to move my promissory note from here down to here. And then once that's been done, I will have my title company reflect that on title that note has been assigned over to this LLC. And henceforth, this tenant will be, or this owner will be notified, no longer make payments here. I want you to start making payments here. So now you've separated out your notes, and you've got your notes now over into this limited liability company. It's going to be receiving the payments. Why am I doing this? Because I don't want my real estate structures here that have real estate associated with them holding on to promissory notes, because those are safe assets. I want to get those assets down here into a separate company, and I can have as many assets as I want down in here, promissory notes that I'm holding on to. Now, to do all of this, keep in mind, depending on how your entities are set up for tax purposes, you're going to have a professional look at it to make sure that you can do what I just described here to get those notes out of there and move them over to another entity like this to be your note holding entity. And typically the note holding entity is going to be that entity where you hold your cash that you're going to use for investing, your savings, things like that. That would be this one entity here. And so many investors that I work with, and even my own investing, I have 2 Wyoming LLCs. I have one here that holds all of my real estate investment LLC. So they're all down into here. And then I have a second Wyoming LLC over here that holds my cash, my notes. I even put my Charles Schwab brokerage account inside of here. That's all over here because that's my safe assets. And so when, if I need to make like I gap funded a deal not too long ago for a friend, I gap funded that deal out of this entity right here because the deed of trust that I took back, I say gap fund, I meant bridge loan. The money that I took back on this deal, the note that I took back went right back to this LLC. I had no problem holding the note in that limited liability company because it doesn't create liability for me. So this is completely different than when you sell something on a land contract. I'm going to cut another video on that. So if you're curious about land contracts, how they work, I'll explain it. But in this context, selling on an installment sale, you have to know this. This is an investment deal. This is something that you bought with the intention of holding it as an investment, not to flip. So the way it's going to be taxed is in that way in which I showed you, portion, portion, portion. Once the deal's been done, you may want to consider moving the note over to here and shut down that LLC. Why would I do that? Well, maybe this is a disgruntled buyer. They want to come back and sue. LLC's no longer around. Who do they sue? They can't get out of going after the note holder. Note holder, you still have to pay. Or you can just leave it in place if you want to and not do this and just collect the money here and then distribute the money down to here and then out to yourself. Either way, that works. Okay, so now if you flip property, be sure to check out my video next week where I'm going to describe how this strategy works when you're flipping. All right, guys. Hey, if you like the channel, be sure you subscribe to the channel so you get notified of all my recent videos as they come out. A lot of information about real estate investing and tax planning for real estate investors. Thanks.